Lending markets aren't just messy, they're structurally misaligned with today's realities. Assets across nearly every property sector are underwater, lenders are stuck, and the banks don't want the buildings back. They've learned that lesson. We're approaching the end of this extend and pretend phase, and at some point, keys are getting handed back and buildings are getting recapitalized. But this time, we have the new tools and the opportunity to make capital markets more resilient and anti fragile. In a previous video, I issued an ominous warning of what's to come if we pretend like it's business as usual. I also provided some solutions to help navigate this transition and minimize the disruption. Step one was allocating a portion of your cash reserves into Bitcoin. And step two is implementing a new kind of capital structure, a dual collateralized loan that includes Bitcoin. Now, let's start with what that means. Bitcoin is pristine collateral. It settles instantly, it can't be diluted, and it doesn't require trust in a third party. And yes, you can already use Bitcoin as the sole form of collateral to get a loan, but that's not what I'm talking about today. I'm talking about using Bitcoin as a secondary layer in conjunction with the real estate. In real estate, dual collateralized loans are nothing new. Lenders often secure the property itself plus a personal guarantee, a UCC filing, or pledged securities. What's novel here is the exclusive use of Bitcoin as the secondary collateral structured in a long-term credit facility. This is not a mark-to-market margin loan. The lender is underwriting the real estate and the Bitcoin in a unified capital stack. Now, before I get into these three examples, I just want to preface this by saying real estate capital markets gets technical and complicated really quickly. I'm intentionally keeping this simple to illustrate the core ideas. Okay, so example number one is a refinance. And this property owner has been following me and has made the astute decision to accumulate a Bitcoin treasury. So he already holds Bitcoin on the balance sheet. Because he does, he is able to pledge some of his Bitcoin instead of more cash. So let's say we have a 60-40 LTV. He can pledge 10% of the capital stack in Bitcoin. The lender still has a senior lien on the real estate, but they now have an additive liquid layer of collateral. That improves their downside protection. And for the borrower, he's able to preserve his fiat reserves, negotiate better loan terms, and he's maintaining his Bitcoin upside. So I like to think of this as credit enhancement with upside retention. That is a really powerful idea. Now, example two is also a refinance, but in this scenario, the lender sees the value of this strategy and wants in on the action. So let's say you own a $10 million property. You bought it 7 years ago and it's stabilized, but the existing loan is maturing. So you need to refinance it, but rates are high, liquidity is tight, and you prefer not to inject new equity, sell the building, or God forbid, sell your Bitcoin. So in this scenario, the structure could look something like this. The $3 million in equity remains untouched. $6 million is getting refinanced via US dollar senior loan. There is a $1 million Bitcoin sleeve created at the refinance. This is co-funded by the borrower and the lender. So 500K from the borrower, this could be balance sheet Bitcoin or cash, and 500K from the lender. This is fresh capital. The $1 million in Bitcoin is held in a multi-signature wallet with a qualified custodian. So that means that neither party can move this unilaterally. It's locked up and it sits there for the duration of the loan. This works for a couple reasons. One, the borrower is able to avoid injecting additional equity. The lender is getting improved collateral and superior risk adjusted returns compared to conventional debt. The Bitcoin sleeve itself is replacing the need for high cost mezz or pref equity. And then at maturity or refinance, the the Bitcoin appreciation is shared between the two parties. On the other hand, if the Bitcoin depreciates, there's no additional collateral acquired. The downside is limited to the Bitcoin. Example 3 is a new acquisition with a Bitcoin hedge. So let's assume you're acquiring a $10 million property from a third party seller. This seller is expecting all cash proceeds at the closing. So, how does this structure play out here? Well, the buyer is going to provide $3 million in equity. The lender is going to fund $7 million in a US dollar senior loan. And then at closing, both parties are going to contribute an additional 500K each to purchase $1 million in Bitcoin. That Bitcoin is not part of the seller proceeds. It's held in custody and secured under the loan agreement, right? It's sitting in a separate sleeve. Again, it's co-owned and custodied by the borrower and the lender. You can think of it as a Bitcoin-backed mezz layer with no fixed coupon. At exit or refi, the appreciation is shared between the borrower and lender. That can be 50-50, 60-40. That's negotiable based off the deal or the circumstances. Now, the seller is still getting their 10 million bucks, so they're happy. The DSCR is not impacted, nor is the amortization schedule. There's no margin call risk, and there's no taxable event until disposition. So again, you have better aligned incentives. You're replacing the complexity that mezz and pref equity bring to the equation, and you're also diversifying the capital stack. Now, what about volatility? Right now, most people view Bitcoin as unpredictable. The reality is volatility changes when market structure changes. And it has changed in a big way. This is not the Bitcoin market of 2017 or even 2020. When Bitcoin gets locked up in these long-term credit structures that I'm describing, you introduce duration into the asset class, and that duration is trackable. You can calculate that X amount of Bitcoin is locked up for Y number of years. That Bitcoin is effectively off the market. It's not trading, it's not selling. Unless there's a default, it's sitting there. So this creates a forward-looking duration curve for Bitcoin. It's kind of like a yield curve, but for scarcity. And this is something that allocators have not had in the asset class before, and that's predictability. So the volatility doesn't disappear, but it does become less erratic, less reflexive, and it's a lot easier to underwrite this over a 5 to 7 year hold period. So you've heard me say this before, and I'm going to say it again. This is not theoretical. This is happening today. In March of 2025, Newmark Capital refinanced a well-known 63-unit apartment building in Philadelphia using this structure. The deal has earned them a CoStar Impact Award for Multifamily Development of the Year in Philadelphia. I'm going to include the link in the caption so you can check it out for yourself. In the point of the cycle we find ourselves today, it's a perfect time to implement new and innovative structures like these. In a previous video, my call to action was engaging your elected officials. Today's call to action is engaging your lenders and banking partners. They need these products just as much as you and I do. And recently passed legislation has removed some of the regulatory hurdles that were in place previously. So as hurdle rates increase and legacy systems fall further behind, these types of credit structures are not going to be optional. They're going to be essential if you're going to be a successful and profitable real estate investor into the future. So they're a bridge between the old system and the new system. I like to consider it or think of it as like a lifeboat. And me personally, I've jumped into this lifeboat. If you have questions, you're not alone. Put them in the comments below or DM me. I want this to be a safe place for all of us to learn and build together. I'm going to ask you to share this with your clients, share it with your team, and share it with your banking partners. I need your help spreading the word. I appreciate you stopping by, and I look forward to seeing you here next time.